Joining me now is Potomac Wealth Advisors founder and president, Mark Avallone. Mark, great to see you. Thanks so much for being here. This market is trading lower this morning as interest rates move higher, and yet we're still talking about growth for the economy. What is your outlook for the macro story and markets this year?
Well, good morning. And the global macro story was very strong coming into this year, but because of the daily changes and the policy adjustments that we hear and see, it's become a little bit more murky. And we've heard that from the Federal Reserve, and we're seeing that from the major houses now. They're pulling back stock market outlooks, and we're seeing that with these economic forecasts with GDP.
Well, hold on. You're saying that the global story was very strong before Trump's policies?
Well, I'm saying
is that what you just said?
The stock market ran up after the election in the hopes that we would have what we anticipated in the election. There was a Trump rally, so to speak, because of a certain set of policy assumptions were agreed to, or at least believed to be happening. Right. We were going to have less regulation, we were going to have a tax bill, and we were going to have this golden age of America. And since then, the market has not only lost all that froth, all that gain, we're negative. And it's negative because of the uncertainty, and it's largely because of the daily policy changes coming out of Washington.
Right, but you said the global economy was doing well going into it. What you're saying is the stock market has traded down over worries over tariffs, is what you just said. But initially you said that the economy was doing great going in before all of this. That's just not true. Okay, the economy was slowing going into this quarter. We're still expecting growth, and what I asked you was, what are you expecting from the macro story? You're right. The stock market has traded down over nervousness around tariffs, but the macro story was slowing under the Biden administration. So I just want to make sure that I understood what you were saying.
I'm not saluting the Biden economy. What I was talking about was exactly what you referenced, that when the election happened, we had the table set for a strong market. The overhang in the economy in the Biden administration was largely inflation, and the goal is to bring that down. We did have 4% unemployment, and we did have GDP in the 3%. The issue was inflation. So now when we look out, inflation has moderated. It's gone down to 2.8. This economy is not catastrophic. We still have unemployment at 4.1%. We still have wage growth at 4%. The GDP now is giving signs, as you led in the lead-in, that it's going to be perhaps below 2. That is a weakening economy. That is all relatively new. The GDP decline estimate is relatively new. And I think that goes back to uncertainty, fear, and that is what the Fed said why they're going to be on hold. So I don't think you and I are in a disagreement here. I'm more in the timing of this is a relatively new development from the GDP standpoint, and that's what, and the policy uncertainty, that's what's causing the jitters in the market.
Yeah, the yields on the 10-year right now are higher, and I want to get your take on interest rates because the Fed, of course, kicks off its two-day policy meeting today. It is widely expected that we will not see a move in interest rates. However, we will hear from Jay Powell at 2:30 p.m. Eastern tomorrow on Wednesday's decision. There is some fear of stagflation. The yield on the 10-year now back above 4.3%. What are you expecting from the Fed when we hear from Jay Powell tomorrow?
Well, the yield back to 4.3 is actually a positive. You know, it was a little bit higher a few months ago. The bond market had some struggles. So that's favorable from this decline in inflation. The challenge for investors and market watchers is this decline in rates, 4.3 on the 10-year, is lower than it has been. Is this recent decline in rates due to fears of a slowing economy, or is inflation under control? Or is it a little bit of both? The Fed is in a tough spot because what's happening with tariff talk and the prior administration's inflation numbers is inflation expectations have not lowered for consumers. And history shows when inflation expectations remain high from consumers, they continue to demand higher wages. And that's why we see wage growth in the 4% range. So if we have persistent inflation above their 2% target and a slowing economy, that's why you're hearing about the risk of stagflation. So the Fed instead is going to stay on the sidelines because they don't want to be the story. They were the story when they missed the inflation run-up under the prior administration. They They pulled back 50 basis points in October, another in November. The timing of that's very questionable before an election, and now they say they're going to be on hold. So I think they want to pull back and not be the story, because stagflation, we saw it in the mid-70s. It is a disaster. It crushes the stock market. It hurts individuals. Inflation and a slowing economy is probably the worst outcome that we could possibly face.
Wow. Mark Tepper, jump in here.
Yeah, Maria and Mark, I mean, as it currently stands right now, what's being priced in is the next Fed cut would happen somewhere in maybe the July meeting or so. I'm wondering if it actually happens sooner, Mark. I mean, what I'm looking at right now is consumer sentiment obviously pulling back. Small businesses are kind of in this wait-and-see mode right now, where they're trying to figure out what the clarity is going to be surrounding tariffs. And then 90-day delinquencies, which is something we're tracking on both auto loans and credit cards, have been going up well prior to the election, and they continue to go up, and they're potentially approaching some problematic levels. Do you think there's a chance the Fed cuts sooner than that July meeting?
I think they really want to, but I think they're worried about inflation pressures from higher costs due to a potential tariff war. And that's what puts them in such a tough position. There's also 4% wage growth coming out of the Atlanta Fed. That's a real cost push. We saw in the late 70s when inflation expectations and wages remained high, inflation follows because businesses pass that along as a cost. So if you couple persistent wage growth and you couple the risk of higher input costs from tariffs, you could see persistent inflation. What we don't want are prices to come down because it's a slowing economy. And that's why the Fed's in a delicate dance. They may cut once or twice sooner as opposed to later, but we're done with 50 basis point cuts, and we're not going to get those 4 that may have been hoped for earlier in the year. The Fed has said they want to let this tariff story play out. It's huge on the global trade front, and it could have inflationary impact back home.
All right, we will leave it there. Mark, great to get your take on all of this. Thanks so much.
Good to be here.